Good day, subscribers. Thank you so much for joining me today. I am Jeremy. This is the Financial Education Channel, and today we're talking about stock market at all-time highs. The stock market closed today at all-time highs, the highest it's ever been in history, guys. And the question is, when you see a day like today, you wonder, are we in a big bubble? Is this bubble about to pop? And I pulled up a lot of statistics and things we're gonna dive into here today on this video and look and see, do we have something to worry about out there, or are things just copacetic? Are things okay? You know, is the stock market a good value right now to get into? Is it an overpriced value if you're buying in? All those kinds of things, guys. And the reason I don't do a lot of macroeconomic related videos on this channel is mainly because I have like a philosophy that if you focus on small companies, if you focus on investing in the small companies that will do well despite a recession or despite anything that happens out there, then you're doing your job. You're doing your job, right? You can't just sit there worrying about if the next recession's coming or if we're in a bubble and all those kinds of things. But I am aware and I do pay attention to these kinds of things. And I have a perfect analogy, guys. Say there's three guys. They're all going out surfing, right? Well, one guy decides he's just going to sit on the beach all day because he heard there were a couple sharks in that water a few months ago, and he's like, "Screw that! I'm just going to look out there. I don't want to get eaten. I do not want to get eaten. I'm just going to look for sharks all day." Another guy, he goes out there. He doesn't care about anything. He's like, "I'm just going to have fun. I don't care about sharks." The third guy, he goes out there and he surfs. He has a great time, but he's always paying attention to his surroundings. He's always aware, you know, looking out for things, but he's having a great time. I like to be that third guy. The third guy is the guy I like to be, where I'm in the markets, I'm doing things, I'm investing, I'm trying to make money, I am making money, all those kinds of things, but I'm also aware, I'm paying attention to what's going on in case that shark does come. I don't want to be eaten, whereas the second guy, he might just get eaten, and the first guy, he's never going to make any damn money no matter what because he's never involved in the stock market, and he's just a negative Nancy who thinks, oh, everything's overvalued no matter what. They always have a reason and whatnot. So that's my analogy, guys. So let's dive into this. So first off, the stock market closed at pretty close to 20,000. We're approaching now 19,750. It's amazing because when I started in stocks, the Dow was at like 7,000. That doesn't seem that long ago, guys. It was like 8 years ago or something. It's amazing where it's at now. Now, one of the statistics I love to look at is the S&P 500 PE ratio as a whole. So taking all the companies that are in the S&P 500, what their earnings were last year versus what their stock prices are currently. Right now, we have a value of, a PE ratio of 26. That's very, very high, unless we assume that companies are earning a lot more this year and will earn a lot more next year than they did last year. So this is a trailing ratio here, guys. So it's basically everything the companies earned last year versus their current stock price. But you can see that's much higher than any years in recent history. The last time it was this high was 2009, which was in the Great Recession, guys. It's never even been close to this high lately. You know, we had a 20 in 2010. We had 16 in 2011. 2012, we had 14. It was unbelievable. 2013, 17, and then it's just gotten higher and higher and higher until now we're at a 26, so super high. But, you know, we got a lot more things to dive into here. 2010 to 2012, by the way, my favorite time ever investing. It was like shooting fish in a barrel because companies' profits were going up much higher. PE ratios were relatively low. You know, that's why one of the main reasons I had such great returns is most of the companies you could invest in during those years, most of them went up. Some of them went up a lot more than others, but most of them went up as a general whole because everybody's earnings were pretty much going up and PE ratios were so low. It was a fabulous, fabulous, fabulous time to be investing, guys, 2010 to 2012. So let's go ahead and look at this here, guys. This is basically what I have pulled up here. This is GDP growth. And this is for the entire world. So it's taken into the entire world GDP growth. And look at, we're on a pretty low level here. If you see the basic mean, it's around a 3. For the last few years here, guys, last 3-4 years, we're under 3. We're at about 2.5. And that's kind of where we're stuck right now. You can see when times are really great and things are growing very nicely, we're well over a 4, but the median ratio is about a 3. So we've been under 3 for a little while now, a few years here, guys. So that to me shows that unless we can get back above 3, we're probably overvalued a bit, because how are companies supposed to bring down those PE ratios a lot if the GDP growth around the world is not going to pick up to a substantial amount? You can see years when we had great GDP growth. We had also great stock performances. Generally speaking, you can look back, most of those years when the world GDP growth was over 4%, those are generally pretty good years to be in the stock market. Very good years, guys. I can tell you 2010, look at where the GDP growth was, 2011, and I can tell you the stock market went up quite nicely those years. It was quite a nice year. So I'm looking at this and I'm like, GDP growth really has to get back above 3% worldwide for us to bring down those PE ratios a bit. Now, this is from the Wall Street Journal, and I've been thinking this for a while now. And this was basically an article posted from October, so a couple months ago. The Federal Reserve officials are concerned about rising corporate borrowing levels. Minutes from the Fed's most recent meeting show. According to the minutes from the late September policy meeting, released Wednesday, some members of the Federal Open Market Committee worried about some corporations are using ultra-low rates to do more than usual borrowing. A few participants expressed concern that protracted period of very low interest rates might be encouraging excessive borrowing and increased leverage in non-financial corporate sector, the minutes say. I've seen this, guys, time and time again. Some of these huge companies, big companies, even Apple, for instance, are taking out billions of dollars, tens of billions of dollars, sometimes even hundreds of billions of dollars worth of debt, basically to buy back their own stock. It's not like a lot of these companies are like borrowing to build huge manufacturing facilities and create all these kinds of jobs. A lot of them are borrowing money straight up so they can buy back their debt. And they're paying it at such a low interest rate that they're like, okay, that's fine. We'll just pay it at a 2-3% interest rate. Let's take out a big fat loan and buy back stock. And it's financial engineering at its finest. And I've seen this with so many huge companies, guys. So I've been thinking this for a while. The Fed's now talking about it, and it's a big concern. Let's look at some statistics here, guys. Borrowing surge. Look at the U.S. sales of investment-grade non-financial corporate debt year to date. Look at how high it is. It's by far the highest it's ever been in the history of the United States here, guys. Unbelievable. It's way higher than right before the financial crisis, which you see how high it was right before the financial crisis there in 2008. Look at where we're at here, guys. Almost $700 billion. And like I said, this money is not being really used to make a bunch more jobs or create a bunch more manufacturing facilities and all that kind of stuff. This money's mainly being borrowed just to take out debt so they can buy back stock. Financial engineering, guys. Some even take out debt to pay dividends. And I think that is so ridiculous. I'm like, how is that even allowed? You can take out debt to pay dividends. It's insane. But that's what's going on, guys. So I look at this and it worries me. It worries me. Do I go ahead and jump out of the stock market now? No. Now, there's one last factor, and I can't give you any statistics behind this. I can't show you any facts or figures. It's called the Jeremy reading. Basically, what the Jeremy reading is I look through companies constantly, guys. You know that. I do it on this channel. I do it in my private time, all those kinds of things. When I have a lot of trouble finding good deals, that means we're probably a little overvalued in the market. Right now, I have the hardest time I've ever had in my investing life finding good deals in the stock market. A la why I went 100% in GoPro. I posted the video yesterday on I'm 100% in one stock. Usually I only go 100% in one stock if I believe in it so much like we talked about, and I can't find that many other good deals. I look around and I don't see much for good deals. You know, I like Win and I like Apple and I was invested in those, and I think they're still decent values, but even those names, they're not like, oh my gosh, this is the greatest deal ever in history. And I see so many overvalued companies. I see a lot of companies that I'm like, I wouldn't want to really buy that. I wouldn't really want to buy that. I search through these stocks and it's so hard for me to find a buy, guys. You know, we do the is it a buy section on the channel every week. So many of those companies are almost never a buy. I'm like, well, if it dropped 10 or 20%, then it's a buy. But it's so hard to find value out there right now. So that's the Jeremy reading. And I think this is just kind of like, I don't know. We don't know. Unless world GDP growth really takes off, then we can begin to see the PE ratios on a lot of these companies come down quite substantially to more of a middle range, because average PE ratio on the S&P 500 is usually around 15. So we're way, way, way above that, guys. We'll see how this plays out. It will be fun to see. Well, hopefully, unless we end up in a recession or something, that won't be fun unless you're a short seller. And then in that case, good luck. Anyways, thank you so much for watching. If you've come across this video and you have not subscribed yet, you may want to. I talk about personal finance on the channel. Talk about entrepreneurship. I'm an entrepreneur. And we also talk the stock market the most on this channel. Thank you for watching, guys, and have a great day.